So the first thing is, when it comes to lending, there are two common lending categories that come into play here, and they're the most common lending categories when it comes to real estate lending, right? And number one, it is a bridge loan, right? A bridge loan is used for specifically acquisition and rehab or construction. That is the purpose of using a bridge loan, all right? Bridge loans tend to be higher interest rate. They tend to be interest only. They tend to be short term. Short term could be 6 months, 1 year, 2 years, 3 years. Best way to understand it is the bridge is exactly what it sounds like. It is a bridge from one point to the next. The reason a bridge loan is needed is because the second lending category is permanent, right? Permanent is the mortgage product that most people are most commonly aware of. It is a 30, 25, or 20-year amortized loan that will be self-liquidating, meaning it will be paid off when you reach the maturity, which would be again 30, 25, or 20 years. All right, so that is a permanent loan. So the bridge takes you from a point where you have a property that is usually unqualified for permanent financing. And what makes it unqualified for permanent financing is there might not be a C of O. There might not be tenants in the property, right? Which on the permanent side, they're looking to lend on a finished product, not a product where there remains many ifs in place, right? So the permanent loan is, as it sounds, it is permanent. It is used really to self-liquidate over a period of time, all right? So bridge and perm. The B.R.R.R strategy, the B.R.R.R strategy is going to encompass both of those things. The second fundamental in real estate investing that is important for you to grip is the three main ways to win in a real estate investment. Those three things are, number one, value add or appreciation. The second is cash flow. And the third is equity. Depending on your real estate investment strategy, components of all of those things will be in place, but some strategies prioritize one of those components more than the other, right? So for example, buying a stabilized rental property with a permanent loan, you're at that point prioritizing cash flow and equity over appreciation. It is very easy to have a property that is a rental property that you are gaining cash flow and you are building up equity over years as you are paying down your principal mortgage, but the property may also not really appreciate in value, right? So you're picking your priorities there, all right? So the way that those three pieces kind of blend with the two main loan categories, bridge and perm, is this. Typically, when you're doing a bridge loan, your priority is appreciation, all right? When you're doing a permanent loan, your priority is cash flow and equity. The great thing about the B.R.R.R strategy is if it is done correctly, you're going to kind of get a blend of all three of those winning factors into one deal. And that's why the B.R.R.R strategy is what I consider the most optimal real estate investment, especially when it comes to residential real estate. Now, let me preface that by saying that uh, the B.R.R.R strategy is extremely common when it comes to multifamily investments. And when I say multifamily investments, I'm speaking more of large multifamily above 5 units. All right. So the B.R.R.R strategy is really a multifamily or a commercial investment strategy, but of course it works extremely well on the residential side. All right, let's try to share the screen and begin the slideshow. All right, I'm not going to do too much. I'm going to leave it right here. Okay, so the philosophy, using other people's money to get higher return on investments and all the profits. Using someone else's money not only is safer, but can give you a larger ROI with low risk. So I am very sure that everyone here already kind of has that frame of mind and understand why it's important to use quote unquote OPM, other people's money. In my opinion, the strongest benefit to using financing is the ability to transact and execute a deal while remaining or keeping some level of liquidity available for you to be able to potentially acquire another deal or more. Okay. So you want to be able to avoid allocating all of your money into one deal if possible, so that you can be available to bring down more deals as they become available, right? So that's really the philosophy of other people's money. Now, granted, if you have several million dollars, then it's possible that you can pull off multiple deals without using financing, right? That's one way to look at it. The other way to look at is if you have $7 million, well, then if you're using other people's money, then you will be able to pull down deals that are going to be priced much higher. You'll be in that $15 to $20 million deal range, which creates much higher upside in terms of the type of appreciation that you could put onto a property. All right, so whether you are doing a rate and term refinance or a cash out, the key to maximizing your B.R.R.R refinance timeline actually begins during the purchase phase of the property, before you buy during rehab. Now, for all of you that know me, one of the most important things that I like to share with my clients and customers is due diligence. due diligence is really the key to executing this strategy as quickly and efficiently as possible. And I would like to set the expectation of a timeline at 4 to 6 months, right? At 4 to 6 months. Now, why is that the timeline that we're looking at? In real estate investing in general, real estate investing and the optimization of real estate assets is dependent on banks, whether you're using financing or not. At some point, financing comes into play in your transaction, because if you're adding value with the intention of flipping, then you need to understand what type of financing structures your end buyer will be using in order to acquire the property that you're bringing to market, right? So your due diligence upfront needs to encompass financing structures that are going to be used by your end buyer, right? In a flip situation. In a BRRRR situation, you are in essence flipping to yourself, right? So your due diligence needs to encompass the acquisition, the rehab, and your long-term hold after you refinance. So you are going to be putting in place all of the things that need to be in place so that everything moves through very smoothly. And that includes considering what your options are going to be at the refinance portion of this strategy. Now, when it comes to the 4-month timeline, 4 to 6 months, the reason why that's in place is this, and this ties into what I was just speaking about in terms of considering the end financing. Seasoning is the key term. Seasoning. Seasoning comes into play in many different instances. For example, in some cases, you may have to provide bank statements. Your money needs to be seasoned, right? But in this case, seasoning refers to the length of time that you have owned the property. So in many cases, when you're looking to refinance, if you're going to a bank lender, a retail bank lender, Chase, Bank of America, a credit union, they typically want your tenants to be seasoned for 1 year. If that is the situation, then you are going to be inside of this strategy for 1 year before you technically exit into your refinance, because you will not qualify for financing at one of those retail banks unless the tenants have been in place for 1 year. All right. Now, with Express Capital and other lenders in our space, we allow seasoning at typically 6 months. We would consider your tenants to be seasoned, right? And even beyond that, we're looking at not necessarily the length of time that your tenants have been in. Banks will look at that. So if it takes you 6 months to complete your rehab, and then the tenants start taking hold in month number 7, well, it could be 12 months after that before they consider that your tenants are seasoned. All right. So we're going to skip all of that. We're really just going to look at the length of time that you owned the property. And that length of time that you own the property should be about 6 months before you refinance. However, when you're doing this entire situation with ECF, we're going to let you out of your bridge loan after 4 months. So after 4 months, You will then commence the refinance, and by 4 weeks after that, month 5, you will be completely out of the bridge portion and now into your permanent cash flowing portion. And just a quick mention, I'm probably going over things and you probably have questions. If you could jot them down or put them in the chat, and we'll come back to the questions before we end. All right. All right. So before you buy, and now we're going to talk about some of the due diligence, right? Find out how much your property is really worth post-rehab. Before you buy, work with a realtor or other sources that you may have, but obviously a realtor is an excellent source. You should have one on your team, especially if you are doing deals in a specific area. You should gain a mastery of that area and have a realtor as part of your team in that area, right? Work with a realtor, get a solid sense of what the market will say your after repair value is. You might be surprised to find out the property is worth more than that. Selling rather than refinancing is an option. Let me rephrase that or repeat that. You might be surprised to find out that the property is worth more and that selling rather than refinancing is an option. Now, most of you that are working with me know that the strategy usually is whatever works best, right? It's always, if it can turn into a BRRRR, that's always best, right? But if the deal calls for you to sell in order to recoup your funds, take your profit to get to your next deal, then it will be sell, right? But we want to keep all of our options open and have leverage positions available to us as we matriculate through the transaction, so that when the time comes, if you can get the better price, you're going to take the sale. If not, then you might decide to refinance because you can't sell. Whatever makes it work, right? So whatever is the best decision at that time. As just a example, in the multifamily world, it is extremely common for a multifamily sponsor to rehab a property, right? Refinance that property to recoup cash and then put the property on the market. In many cases, when they put the property on the market at that point, they're putting it on the market at a price that they would be willing to sell for, not a price that they have to sell for, right? Because they already have the cash flow win, they already have the equity play in the works, and they already have the appreciation play. So the only thing left is, well, let me put it on the market. If somebody takes it, I'll trade. All right. Next piece, find your refinance lender before you close. Again, we're going to want to put everything in place, right, in month 0. Okay, and we're looking at this again from really 0 to 6, 7 months. Month 0, your due diligence month. Have everything lined up, plan for every possible thing. Line up your refinance lender when you purchase, or at least 1 month prior to when you want to refinance, right? So this is telling you that even when you get to month 5, month 4 is when you should be looking for your refinance lender if you haven't done so already. You should try to have that in place month 0 or month -1 even, right? Know all of these things so that you really, once you are executing, everything has kind of been laid out and you're following a path that you have already created. All right, line up your refinance lender so that they're involved from the beginning. They can help you determine the rates and terms for your carryout loan. That's important, right? You must know what are the prevailing rates and terms. Where will this be in month 5, month 6 in terms of the market and the interest rates. Interest rate doesn't play a big part in the bridge portion. It plays a huge part in the refinance portion because the interest rate is a direct trigger to the debt service, which is then going to indicate to the lender what the property can debt service or what they will be able to lend. So the interest rate is very important in terms of the refinance. So you should have an idea of what that prevailing rate is, and the prevailing rate should be overestimated, right? So you're going to underwrite your exit. If you're going to do it now, you should be underwriting at 7.5% above what the prevailing rate may be, just in case. If the deal works out at that prevailing rate, then you know you have a great deal. All right. As an investor, strategize to keep the property for cash flow or sell it or for high profits on your flip strategy. All right. So again, that's about knowing the lending environment at your exit point so that you can use that info to further refine your strategy. All right. 3, get pre-qualified for the refinance loan. Go ahead and have them pre-qualified. Work up a pro-forma. The pro-forma is, and it's going to be much easier in a residential property than a commercial property because you're not dealing with estimating rents on multiple units. You're estimating rents on maybe just 1 or 2 units in that case. Your pro-forma is your estimation of rent, basically your estimation of income and expenses at month 6 or month 5. So once you're completed, what are you expecting to rent the units for? And what will be your expenses? Most commonly, your taxes and insurance expenses. And that will have that deal pre-qualified early so that, again, your path is laid out and you are following that path to execute your deal. Depending on the type of loan you secure, the lender will want to review your credit score, your debt to income if you're going to a bank, your DSCR if you are dealing with a investment purpose lender like Express Capital. Get all of your documents in line. In this case, if you're talking about DTI, you may be having to show your W-2s. You will definitely be showing your W-2s. Make sure your credit is on point, of course. And again, refinancing that end loan, you want to be in the best possible position, and that's where your credit comes into play. Higher the score, lower the rate, the more you'll be able to borrow. If you are working with shorter B.R.R. timelines, which we're looking at a 4 to 6 month timeline, you can get pre-qualified for your refinance loan during your purchase phase, right? So put all of that towards the front of the transaction as possible. If you're working with longer timelines, right? So now you're doing a larger property, maybe a large mixed use property or a multifamily property, and you know that your rehab is going to be 7 or 8 months. Right? Then you want to wait because you definitely don't want the lenders running your credit multiple times before you get to that point. You should be monitoring your own credit using sites like myfico.com, which is a great one, a good trick there. Create an account at myfico.com, pull down your tri-merge, and then cancel that account. You won't have to pay for it. All right. Gather your documents. All right. So we just discussed this. Get all of these things in line. You should have a file, real estate investors. You should have this as a file already in your system. So, and keep it fresh. So at the point where 2023 rolls along, then you want to remove your 2019 W-2, replace it with your new W-2. Okay. Keep recent pay stubs. Not that you want to necessarily update this file on every pay period, right? But potentially put in your updated pay stubs every 6 months or so, depending on what your timelines are in terms of projects that are pending. Bank statements, a copy of your license, of course. Your other liquidity statements, your stocks, your life insurance, all of those, you can really keep those in one file, keep them in a neat stack, don't spread them out, make it easy for a lender to look at. When I look at your W-2, I don't necessarily want to see 2021 and then the next one be 2019 and then the one after that be 2020. It's just a small thing, but having them stacked in order, right, creates some continuity that underwriters would appreciate, because that's really helps them to get through your qualifications very quickly, right? Remember about seasoning, okay? Whether it's seasoning your liquidity, I'm not even quite sure what this particular season must be seasoned for 12 months, but your leases, all of those things, keep everything in order. Your operating agreement, your articles of incorporation, good standing. If your LLC is older than 12 months, you need a certificate of good standing. Don't wait. You have a loan file. You should have this file. Know that that expires every 12 months and you need to replace it. Okay. Next thing, during the rehab, schedule your appraisal, right? As you get close to completing your rehab, right? The appraisal phase can be the longest part of the refinance process. Be sure to schedule the appraisal immediately after applying for your loan, because this step can be long. Start your refi about 3 to 4 weeks prior to when you plan to put the property in service. Now, you're not going to order your own appraisal. You may run into issues there when you try to present that appraisal to your lender. But you do need to know that the appraisal process is the key component to your processing, the loan processing type timeline. So what that means is when you submit the application, then you need to be on your loan officer or on your lender to have that appraisal scheduled. Every day that that appraisal is not scheduled, right, is costing you money. And again, something I always like to mention about these deals, especially value add deals, every day costs you $1. Every single day you are in your project costs you. When you enter a project, you enter that project with a margin, a spread. So if you go into a deal, the day that you take that deal, you close on the acquisition and you have a spread on that day of 130, all right, or 100,000, a nice even number. Every day that 100 gets eaten away, right? If you're in a deal for 12 months, that $100,000 spread is going to end up at 21, 22, 23, 24,000. Right? Your costs are eating interest, taxes, insurance. Every day that you're in a deal, it actually costs you money. So the shorter time that it takes for you to complete this, the more money you actually make. It's that important. All right, so prepare a little package for the appraiser. And we already spoke about this. You're going to already have everything that is could possibly be needed in a file. And I can share that with anyone that needs it. I can give you pretty much a list of every possible document that would be required in any mortgage situation or any lending situation, so that you can, ahead of time, even before you even get to your first deal, you could be month -2, month -3, -4, have all these things set up in a file and refreshed whenever needed, so that you can be able to share them as quickly as possible and not have to look for them. All right, so a one-page document of interior and exterior updates you've made since close. Now, the scope of work is important. And where is that? Is not a scope of work. Okay. All right. So your scope of work is important. In this case that you've already done a rehab and now you're looking to refinance. The lender is going to want to know, how do you justify the increased property value? And you're going to justify that increased property value by showing, with your scope of work, the work that you actually have done. So you're going to use the scope of work in the acquisition and rehab portion. Your bridge lender is going to require that scope of work. So you will have that scope of work. You're going to then share that at the end with the refinance lender and that appraiser that's appraising for the refinance lender, so that you can justify the added value to this property, right? In some cases, you should save your permits, your receipts, definitely photos before and after. Be a photo maniac, right? Take pictures of everything before, take pictures after. Not only will it serve you in terms of being able to justify added value, but it also is just great keepsake for you, as something that you can just look at, recollect, and learn from, right? And just kind of keep as just some sort of a keepsake to kind of show your deal experience. Okay. Follow up with your lender post appraisal to make sure things are on track. And again, this is more about the refinance. Getting the appraisal done is one thing. Getting it back from the lender is entirely different thing. Touch base with your lender 3 days post appraisal to understand when the appraisal will be back and what else is needed to close the deal. People get busy, and refinances don't have a hard and fast closing date, so they tend to get pushed to the side in favor of purchases. All right, so we're spilling the tea here, right? We're giving you the truth about lending, and certain deals take priority. Refinances typically are not the priority, right? Put yourself in the shoes of a purchaser with a hard timeline and understand that, you know, if you're dealing with a lender, you don't necessarily want to fall into their queue and be mixed in with the queue of people refinancing and not necessarily on a timeline where they have to close in 30 days, 45 days, or less, right? In some cases, right? You're getting a property from an auction, you may have 3 weeks, right? So be on top of that, but again, be cognizant that, you know, it is a refinance, but your refinance here is technically, it's a refinance, but it's a purchase because you're flipping to yourself. So you're buying. And again, every day costs you $1 because you're in a position where you're paying interest on your bridge. All right. So these are popular loan programs. And again, Rental 360, that's the permanent loan. It's a 650 to qualify for that. So 650 is the minimum that you need. And that's pretty much across the industry in terms of your permanent loan. Rental 360 just indicates 360 months, 30 years rental loan, right? You're going to need a 650 to qualify for that. And again, that is pretty much industry wide. Loan to values, when you're refinancing with this B.R.R.R strategy, you're hoping to get to a 70 or 75% LTV so you can recoup as much of your cash as possible. Okay, those are some common loan programs. All right, so I would like to, before we go to questions, just run through a quick example, a deal example. All right. This is 123 Gibson Avenue in White Plains. I just pulled this up so that you can get a solid example of what a B.R.R.R is going to look like on this property. This is currently listed for sale. Like I said, I just pulled it up. Anytime you're searching for value add, you always go to the bottom of the market, meaning you're searching for properties in many cases that you filter with lowest price. Bring the lowest price to the top, and that's going to get you the properties that are most likely viable value add deals. So if you know White Plains, you know 429 is a great price. The other thing that you're looking for when you're looking at these opportunities to add value, of course, you're looking for dated interiors. The dated interiors, that is the key to adding value. All right, so this property fits the mold. All right, I believe it's in foreclosure, but it is currently listed at 429. Now, the next thing I want to know is, well, if it's listed at 429, what's a potential ARV? Now, I happen to have some different tools, right? Deal Machine is one tool that I use. It is available to the public, right, at a price, a monthly subscription. Deal Machine is great because you can do a few different things, but more commonly, I'm looking for comps, right? And Deal Machine gives me comps. All right, so 123 Gibson Avenue, there's some basic information about it. It's going to be listed here. The realtor's information that has the property listed is all there. 3-bedroom, 2-bathroom, square footage. You're keeping all that in mind as you're looking to project the future value. All right, and then we're going to click on comps, and then Deal Machine is going to give me properties in the area that have sold recently, and it's going to give me an estimation of value. Now, Deal Machine is estimating value based on what properties of this size have sold for. So size, bathroom count, bedroom count. So Deal Machine does not know that the interior is dated. All right. So it's telling us what the value of the property should be. And now your job is to get it there. And you get it there again by updating the interior as nice as possible. In some cases, you could potentially, if the neighborhood is right, go to high-end finishes that may push that value beyond what these comps might show. Right, so this property comps out at 645. So now let's look at our setup. All right, So very quickly, this is our loan setup. As is value is always the price that you're purchasing for and any additions that you've made unless you're beyond 1 year. So this is where seasoning comes in again, right? You're not technically seasoned unless you've had that property for 1 year. All right. So if you're not seasoned, then the value of the property is the price you paid for it. So you cannot buy a property for 400,000, even though its real value might be 700,000. And then after you buy that property, go to the bank with a value of 700,000 and try to refinance it. They won't do that, right? Because it has to have 12 months of seasoning, and it's really a fraud prevention mechanism. All right, so that values are not getting artificially inflated. So your value is, your as-is value is the price you paid for it plus any actual rehab that you've done to the property. So if you're paying $430 for the property and you did $30,000 in rehab, then your as-is value is going to be $460. Okay, so $429, the as-is value here. And then we're going to project a $45,000 construction budget on this property. And we're going to go back to that after repair value, which is $630. All right. Over here, we're looking at what we're lending on the property, right? Say let's imagine we're still lending 90%, and you're still getting 90% easily in the market. Not really the case right now, but will probably be the case again soon. But let's set this up at 90%. 90% of your acquisition price, and then 100% of the rehab is how your bridge loan is going to be structured. All right. Now, that brings us here. Your total loan amount for this acquisition and rehab deal is going to be $431. You're going to get $386 as your loan towards your acquisition. All right. So that is 90% of the $429. Then you're going to get $45,000 for rehab in a rehab holdback. That is your draws for your construction draws. So you're going to advance your rehab, and then you are going to request reimbursement for each of the phases of rehab that you complete until you're reimbursed the full $45,000, and that's where you get your $431,000 loan amount. Cash into this deal, extremely important. $55,000 would be your cash into this deal. $43,000, $42,900 as a down payment, $12,000 in closing costs, and the actual cash you're putting into the deal, $55,114. There's going to be some other small incidentals that get added to that, but we're not going to necessarily look at that from a loan underwriting standpoint. All right, now let's look at your deal economics. This will be the last part before we go to questions. All right, $429 purchase price, $629 ARV, $45,000 renovation budget, typical interest and points. And we have this set up as a 6-month time to flip, or again, flipping to yourself. All right. New Yorkers have mortgage tax. We just throw some extra fees in here, transfer tax and mansion tax, although these may not qualify. Title insurance costs, typically if you're estimating what your cost might be on a deal, feel free to tack on 1 or 2% for title insurance. 2% will have you well over where your title insurance should be. 1% is a fair estimation, but feel free to go to 2. Your refinance origination, projecting 2%, property tax, so on. Initial loan amount we spoke about before, rehab holdback, total loan amount, ARLTV, after repair LTV. That is the amount that you are borrowing, your loan amount compared to your after repair value. Your loan amount expressed as a percentage of after repair value, your ARLTV. All right, now acquisition cost, price, title fees, all of the above brings us to a 449 acquisition cost. The interim cost, and this is where I am telling you that once you're in a deal, you're paying every day, regardless of if you are conscious of it or not. All right, these are adding up on a daily basis. Faster you get out of the deal, the better. Costs associated with your refinance, right? Again, origination, title, attorney fees, so on and so forth. Refinance value. This is, again, our ARV. We're at 629,000. Total cost, 534. Profit on this deal is 94,974. All right, that is total cost to refinance value, your ARV. All right, now let's break that down just a little bit further. Refinance value 629, purchase price 429, reno, your total project cost. Again, if you flipped this property, the profit is 93,849. That is expressed after 6 months. Okay, if I were to change this to 12 months, now your profit would be reduced to 66. That's how important your timeline is. All right, so we're looking at this as a 6-month deal. Cash into deal, 6 months. And again, this is not necessarily cash that is coming from you. This is cash that includes your not only your carrying costs, but the cost of the renovation that's being funded. Okay. So this is the exit info. Now we want to exit at 75 LTV if possible. To ensure that you get close to that 75 as possible, you got to remember your debt service coverage ratio, DSCR, needs to be 1.2. That reflects, 1.2 reflects the amount that the lender is, that your expenses are covering, then your profit above your expenses. So 75% LTV with a prevailing rate of 7.5. Remember, we are underwriting a future refinance. The refinance loan amount would be 471, which would then get us cash back of 40,000. All right. And here you're just looking at the rental income for that property, for this property. I'm projecting at 6,400 a month, right? Which might be high for this specific property, but using it for this example. How long it would take you to recoup, right, as a straight rental. Okay, and now over here, I have a quick breakdown. Your permanent loan amount was 471, right? So you're refinancing at 75%. That's the 471. So this is your refinance loan amount. You added value, you got the value to 629. You're now refinancing at 75%, which now brings you to a 471 loan amount. You're paying off your bridge loan. That's 431,000. Estimating closing costs at 4% leaves you with 21,000. So now you have a 471 loan at refinance. You pay off your existing bridge loan 431 after 5 months, 6 months. This is a high estimation of closing costs. And this is the remaining. So you were able to, with this deal, and this is not super far-fetched. This property exists. This property is for sale. This property is significantly undervalued at 429 because it's a foreclosure. This property has a legitimate after repair value of 630. The only thing that I stretched in this model is potentially the rental income at 6,500. All right. So again, refinance loan amount 471, bridge loan payoff at 431. Now you have the property, you have the cash flow, which is indicated here, and you are able to recoup some of the cash that you put into the deal to begin with. All right. So that is the full setup. If anyone has any questions, I am not quite sure how to take questions, but I believe you can type it into the chat. Feel free to do so now. Or you can raise your hand and I see the buttons where I can allow you to talk. Okay, I am going to take that as no one has any more questions. All right, so if you do have other questions that you would like me to address, feel free to send me an email, right? Of course, I'll be more than happy to go back over some of this with you. Most of the people here are already signed clients of mine, all right, which is great. So feel free to send an email, give me a call, whatever you want to do to ask any questions that you might have had about this. And if there isn't anything else, we're going to end as we are now over pretty much close to an hour. So I'm just going to give one more shot for anyone to ask any questions. Other than that, I'm just going to assume that I did a magnificent job and there are no questions. All right, great. All right, thank you so much, ladies and gentlemen. I really appreciate everyone attending. It was a pleasure. And of course, again, reach out with any questions. I'll be more than happy to help. All right, thanks again. See you soon.